again, everyone. While we have our panelists here, indeed, we're going to talk about some of the new models that are emerging for raising capital, especially when it comes to Africa. The title of the panel was about the new models that have emerged through the pandemic. There's also a discussion that we were having preparing for this panel is whether this is a natural evolution or not, but we'll delve into that quickly. We're fortunate to discuss this panel with three investors at various levels. Gonçalo Neves-Correia with ThirdWay Capital, Abderahmane Fodil from AD Emerging Markets, and Mack Schow from DEG. I'm sure you've met everyone more or less during the last few days on the conference, but it would be maybe interesting if each of you could say a few words about your organization and how relevant you are to this panel, because you see, or you have created yourselves a few models. So without getting into the details, just explain to us what you do and in relation to Africa in particular. Maybe Gonçalo, you want to get us started here.
Perfect. Thanks very much, Alexandre. So I'm a partner at ThirdWay Partners. We focus primarily on Africa, although not exclusively, and on all things sustainable development from either an investment or advisory basis. On the asset management side, we have a permanent capital vehicle, which is, I guess, one reason why we may be relevant to this panel. And then on the advisory side, we've worked with some alternative models, platforms, SPACs, not so much in the African context. And so also happy to chat about that.
Abderahmane?
Hi everybody, my name is Abderahmane Fodil. I'm a managing partner with IDI Emerging Markets. We are a private equity firm focusing on emerging or growth markets. We invest in three main geographical areas: Asia, Africa, Middle East, and Latin America, both in the form of direct investments and also through funds. And we have deployed roughly $700 million to date. Based out of Paris, we have an office in Luxembourg and another one in Hong Kong.
Mack?
Yes, hello everyone. My name is Mack Schow. I am co-heading the African Funds and Equity team at DEG. DEG is the German Development Finance Institution. We have around 40 funds in Africa with 26 or 27 managers. So we've seen many different fund structures also emerging. So not only traditional funds, but also some interesting models, for example, platforms and other things that we're working on. Some blended finance models in order to encourage third-party investment or third-party capital investment into Africa. And so happy to be here and happy to get into the discussion.
Great. So let's get started perhaps with this. You mentioned one of the keywords, the platforms. We see some of our clients actually also step away from traditional fundraising to launch platforms and raise capital this way. Have you seen more of those offerings yourself, and have you invested in some of them? And maybe we'll take turns again and see where you've seen some action.
Sure. So I think platforms are becoming more and more common, especially in specific sector-focused platforms. I think it's maybe a way to, it could be, maybe a replacement or a way to supplement the kind of sector-focused funds that haven't been extremely successful. And we were very interested in this model. Why? Because it's a way for a manager who has an asset that's an interesting asset in a certain sector to raise money for that asset, buy it, and then on the back of that well-performing asset, some existing cash flows, go out and raise additional capital, and it makes it much easier for us to go and put a blind pool for a specific sector behind a manager when they already have a couple assets or maybe one or two assets in that platform. So we've done this. We're looking at something in the pharma space. We've done it in the healthcare space before. Mm-hmm. In North Africa, we did it this year in a telecom towers deal with Métier, one of our fund managers. Mm-hmm. And so it's an interesting model. I think it's also interesting for managers that are in between funds. So if you have your fund life has come to the end, not quite there to go out and launch a full process, but you have an interesting deal. You could consider a single asset GP/LP structure, which is something we're interested in. The last thing, which could be an advantage of a platform is for some investors, I think who are restricted into their allocation to funds. Perhaps a platform doesn't count under a fund allocation structure, so it's more of a direct investment. So people, investors that have a certain bucket for funds, a certain bucket for directs, which many do. It's a way to continue to invest when your fund bucket is full.
Yeah, I'm sure Abderahmane, you can echo that as well, because you do direct and fund investments.
Yeah, absolutely. In line with what Mack was saying, we are seeing more platform deals, and we tend to like them. Of course, you have to be careful because you have to look at the governance, exits, which can be new challenges.
Yeah.
But overall, it's interesting plays whereby, again, as Mack was saying, you could have already some kind of visibility over the deployment with the first asset either warehoused or about to be booked. And we like these models, and yeah, they're replacing in a way. We'll see the next couple of years will tell how much that will materialize, but yeah, they are kind of replacing, as you rightly said, to some extent, sector-focused funds, right? With interesting synergies to be brought and that are core to the deployment strategy. So again, governance and exits will be key for these new vehicles, but we see some good traction, and some fund managers have already successfully done it, especially in the healthcare space, and we are seeing some interesting, tech-related initiatives. Food security as well is starting to emerge. So yeah, this is a clear trend. Now, is it linked to COVID, or is it just accelerated by COVID and probably underlying trends? But yeah, it's an interesting trend to watch.
Yeah, I would also say, in our experience, that in these platforms, we've seen some investors that we would not have anticipated.
Yes.
They would not come through funds normally, but with a certain deal, all of a sudden they might be jumping onto the African continent. Gonçalo, I may not ask you to comment on the platforms. I'm not sure if it's your forte, but maybe there are other forms of vehicles that you see emerging, including yours.
Yeah. Well, it's interesting because we normally call our vehicle a permanent capital vehicle, but the reality is because it's single sector focused, it is kind of like a platform. So maybe before we go and talk about other forms, just one thing to add to what my colleagues were saying. I think the other interesting thing that a platform gives you is a currency to go and consolidate assets that may have become stranded. So for example, if you look at agriculture and food security, it's been a challenging sector. The 10-year model hasn't worked very well. There's plenty of kind of, DFI type of capital stuck in assets that, have struggled to kind of scale up. And sometimes, although it doesn't provide you immediate liquidity from a cash standpoint, the attractiveness of going into a kind of a bigger new home with a bit more of a robust kind of corporate structure on top of it is also an attractive, let's say, intermediate exit for some of these smaller assets that can be consolidated into the platform. In terms of other models, we discussed a little bit the notion of blended finance and how it kind of plays into this concept of kind of the new normal. Right now, it's very topical in certain thematics like climate, and I think that's one of the areas where Africa punches above its weight in terms of its ability to bring different types of funding sources into investment vehicles because of the very, very strong relevance of the development ecosystem that maybe you don't have in other parts of the world. And so the ability to, in some ways, evolve the way that funding, whether it's from development agencies, foundations, NGOs, interacts from a kind of a capital attractiveness standpoint, I think is going to be quite topical. And so we're seeing a couple of things. We're seeing development agencies saying it's not so much about how much impact you have. Now it's about what multiplier effect you have. So for every dollar of development funding you put, how many dollars of commercial capital can you attract? And then you think about what's the way of achieving that multiplier effect, whether it's through a first loss tranche or returnable grants or other mechanisms. And two, it's also how do you use that expertise that you may have within, your organization. So, for example, if you're an international NGO like the Nature Conservancy or Conservation International, how can you bring that expertise to play to give credibility to investment products by, let's say, positioning yourself side by side the GP, right, the investment manager, and coming in as the conservation advisor into that vehicle as a way to give comfort to LPs that the vehicle is doing what it says it does from an ESG standpoint.
Yeah. And speaking about first loss mechanisms, you've done it at DG.
Yeah, maybe a few examples there. I mean, one thing you mentioned was blended finance. I think blended finance for us is an interesting. We're not using it, let's say, in every deal, and it's not necessarily what the DEG side of the German Development Cooperation is focused on. That's more KfW Development Bank, but we are setting up a few, and we have set up a few structures in order to try to encourage commercial capital to invest in Africa. One of them, is here today. It's the Africa Grow Fund, which we're an LP in, and we're also we're advising the GP through our subsidiary DG Impact, and it's a fund, 200 million euro fund, where 100 million of that is a first loss coming from the German government. And I think without that, we wouldn't have been able to encourage Allianz Global Investments to invest in Africa. And it's a way for them to take a first step and get some exposure. And we're going to be very diligent in the investment decisions we make within that fund. And hopefully, we don't need the first loss. And it could encourage them to continue to invest in Africa, and we're going to roll this out with other other funds, other investors, not only in Africa but also in Asia, and I think it's important, right? I don't think they would have done it without it. So I think it's a first step. Hopefully, we don't need it in the next fund. The other thing you mentioned was in climate, and I think on climate, when we think about climate for DEG, we've made the commitment to be net zero by 2040. And we're doing this on a portfolio basis, not on a single asset basis, which means we need to offset quite a bit of the more heavy carbon investments that we're going to hopefully continue to make with some carbon sequestration and forestry and nature-based solution investments. And so we're going to put a lot of money behind that, and I don't think we're going to do it in any case in the traditional model. And we've done it a few times in the past in these typical fund structures, and we found a new model. I think it's going to be definitely longer term funds. We did one that we've now just closed a 25-year fund called the Livelihood Carbon Credits Fund, where we're actually not getting any sort of financial return. We're being paid in kind carbon credits, and it's a way for us to offset some of our portfolio. We're looking at permanent capital vehicles on the forestry side because we effectively don't want to sell these assets. We want to keep them and continue to mine the carbon credits as we try to offset our portfolio. And so I think definitely on the climate side, we're going to need new structures because we're not sellers on that side.
And those will attract capital, different pockets of capital as well in your view.
Yeah, so in the Livelihoods Fund, for example, we're the only DFI there. It's you have Danone and Schneider Electric, Mars, so it's commercial investors already looking at that because, they're making commitments as well, and so I think developing these new structures will also attract commercial investment.
There are also, I'm no longer working for IFC, but it's still close to my heart. Also, IFC launched a pretty major initiative in partnership with Amundi, with the concept of first loss, as you described, and they raised over $1 billion, I think. I don't know if there is anyone from IFC here who can confirm, but it's great to see that there are, increasingly initiatives by prominent institutions and DFIs to foster, hopefully, commercial entities to also come to that.
And Abderahmane, when we were preparing for the panel, climate is one of the themes, obviously, that can bring some new capital into Africa. You were alluding to other sectors as well that you've observed would be trigger points forward.
We see, we've seen for the past, I would say, year and a half, a clear trend towards more tech-related businesses. I mean, fintech obviously is almost a tarte à la crème word, given the fact that everyone is talking about it. But beyond fintech, you know, we see a lot of tech-related initiatives in sectors like healthcare, education, financial services. And the interesting thing also is that, well, it's maybe early days, but we see already some very significant, you know, markups. I mean, a company like Mukuru marked up 10 times less than 1 year after it was done and generating revenue. It's not like, you know, pure VC where you bet on the company developing. So this is an interesting trend and clear trend we are seeing, and that could contribute also to attracting new types of capital. I mean, the Middle East is one example. I lived there for 7 years. When I was there, I mean, certain investors looked at Africa, but in a far, let's say, from far away, looking, smelling, touching a little bit, but not really pulling the trigger. Now, you see more, you know, discussions, tangible discussions about investing in tech-related businesses where you have the leapfrogging effect, obviously, and really some innovation that is taking place in Africa, maybe even more than other places. So that's a clear trend that spans across different sectors. And it's not only VC, it's also growth capital to some extent.
When we saw the SPAC in Egypt with Swivel, I think we're in our investee, and in the portfolio of some of our GPs, I think we're going to see another SPAC this year, hopefully. And so it's a way, I guess, to follow this trend to try and bring investors into the tech space. And
so tell us more about this. Is it going to fly? I mean, the SPAC phenomenon, is it going to catch up with the rest?
Look, I think it's a hot topic, and and there's a wave right now. So, you know, African GPs need to also try and get on this wave, especially if they have interesting tech assets. I think that's really the way, the sector that where it's going to work. We've seen one successfully. I think there'll be another one this year, and hopefully there'll be more.
Gonçalo, you work on SPACs as well, but not on Africa yet, huh?
No, I mean, look, there's like 500 SPACs out there looking for targets just in the US, and so, you know, the numbers that we see in Africa, to Mack's point, are still very small. On the tech side, it could be a sector that fits nicely into what's happening with SPACs in the US, because the SPAC market, as we know it today, is a completely new phenomenon. You know, SPACs have been there for a long time, but you had, you know, 10, 20 IPOs globally a year. So things like Atlas Mara in Africa, that was a SPAC, right? But the SPAC market of 2019, 2020, up until April 2021, was a market of going into, you know, VC in the capital markets, right? It's looking at things that have raised $50 million, ascribing a valuation of $1 billion, doing a business combination and hoping that you had enough liquidity. And what we're now seeing is that, you know, the post-IPO performance or the post-business combination performance of those stocks has been pretty bad. And so that put a pause on the SPAC market. And so when you think about Africa, you're just adding another exotic into all of this, because SPACs are quite exotic. What I think is quite interesting about what the SPAC market has shown us, going back to new models for Africa, is the notion of, I don't want a blind pool, right? I want to pay for search. And so go out there, find something attractive, come back to me, and I'll give it a last look. And so, as Mack was saying, you know, for GPs that are in between the, you know, fundraising of one fund and, you know, exiting one fund and fundraising for the next fund, the concept of going to LPs and in particular people, let's say, I don't know, Middle Eastern investors that, you know, haven't done anything in Africa, but they want to feel like they control the asset base, etc. It's an interesting way of creating an alternative structure, you know, whether it's a search fund, whether it's a managed account, but replicating the notion of what a SPAC really is, which is, you know, paying for search, but in the context of private markets.
Makes sense. And if we go back to the PCVs as well, because you've been raising one yourself, what's the reception of? I mean, especially when people, you know, think about liquidity, and how do you manage to attract commercial capital there?
Yeah, I would say that our experience has been more like a normal kind of direct deal, and I'll explain why in a second, and not so much, you know, we're really a private equity fund, but calling ourselves a PCV. let's say like an Africa Capital Works that has been quite successful in terms of raising capital, but calling themselves a PCV. For us, really, it was a journey of warehousing a deal, right? Creating a structure where there is a promoter of the structure, but investors have direct governance because they're shareholders in an investment holding company, and then really facing, quite frankly, the challenges, but sometimes the opportunities of having to raise capital on a phased approach, deal by deal. And so it's worked well. I think it's interesting to see sometimes the schizophrenia of where you fit in. To Mack's point, you go and speak to a DFI, and is it direct? Is it the intermediated equity team, right? Who do you really speak to? And maybe arbitraging that a little bit. Sometimes you can fit into both buckets. Yeah. But it's been a journey. I wouldn't say that we're there yet. We don't have the scale as a PCV that we would like to have, but we have the optionality. Maybe that's also one of the things that a PCV gives you. You don't have the pressure of saying, you have a binary result that you can measure in a kind of an 18-month period. You're always in the trade in some ways if you have a PCV.
Just as an institutional investor, I don't know how I should put it, but you have the ability to invest in direct deals and in funds. You now have the flexibility to do other forms of investments like a PCV or.
Yeah, absolutely. I mean, technically, one of the strengths of our model is really this flexibility, right? I mean, our investors trust us to generate good risk-adjusted returns. We need diversification, but we have a lot of flexibility there. So PCVs could definitely be instruments we look at. I mean, what we're really looking at is the fundamental underlying businesses and then governance and team, right? So long as our criteria are there, we are not too constrained with respect to what we can do. And as I mentioned earlier, I mean, we are seeing very, very attractive, actually, platform deals. Just two caveats, again, repeating myself, but governance and exits are two key elements we really spend time to look at, because we see a lot of pros in this type of platform / PCV structures, but we just want to make sure that the cons don't take over the pros. And so that's maybe a different way to look at investments to some extent. But definitely, I mean, this is something we can do based on the flexibility of our business model.
Is there anything innovative still that we've missed on the fundraising side, Mack, maybe from
Look, on PCVs, we've looked at a number of them. We haven't done any. I see some of our DFI colleagues in the room that have. I think it was a way to support certain topics, maybe some lesser developed markets where there's a manager that has a few assets and you're trying to set up an investment structure to be able to continue to support these assets that need a longer lifetime to grow in order to attract liquidity versus a fund. But if we're looking at separating, we talked a lot about platforms and that's similar, but say pure blind pool PCV, I think we would need to understand what the incentive would be to do that as opposed to just the traditional fund structure, right? And so that's why this is why we haven't done it in the past, and I think we would rather look at a more of a platform where there's a specific asset to start, or 3 assets to start, where we're funding those plus adding additional blind pool on top of that, and then trying to figure out the fee and the exit structure around those assets.
I think we have about 5 minutes left. I was wondering if there are any questions from the audience that we should address. I'm sure some of you are currently raising some innovative structures and have questions to our panelists. There's one in the back, yeah.
Yes, I'm wondering with the Good morning, Tom Tom Scriven from RPCK. Thanks so much for your insights on some of these alternative structures. Many of the folks that we work with are considering them, so this is very helpful. With respect to the platform structures, how do you address follow-on investments to ensure that the investments are adequately funded as the life of the investment continues?
By follow-on investments, you mean how we address the fact that these will require additional funding, or the fact that there is not always a lot of visibility over the next assets of the platform? The first. It's a good question.
Yes, I think it's important for the manager to select the right investors that have deeper pockets. And so, I mean, when we're doing if we're doing a platform, the first investment we're doing won't be the max that we're able to allocate to that platform. And so, we can either do it in some ways. We think about funding that first acquisition and then putting a blind pool in place to do additional acquisitions or follow on. And on the other hand, we could think about just knowing, overcommitting ourselves internally and saying, like, we know we're going to commit further capital. There is always the challenge around, if not every investor in that fund or in that platform, is going to recommit, then there's a valuation discussion. So that needs to be set up beforehand, how that, a certain period of time, perhaps, where the valuation stays the same, and then there's maybe an external valuation that happens thereafter. But yeah, I mean, we always think about, when we're doing a platform, not to commit our maximum up front, but rather to leave room for additional investment.
And also with respect to other investors coming later on, potentially, we are learning while working on this, because these are new structures, but we also try to really look at the whole story, not only the investments and the thesis as it appears, but potentially, the prospects for follow-on acquisitions, because at the end of the day, that's also what will drive either existing investors to commit more or new investors to come later on, right? Of course, there's no commitment. I mean, there's a right balance. It's more a roadmap with 1 or 2 existing assets and maybe 3, 4 potential targets at the second stage. But still, the cohesion of the whole story, and together with the governance, I'm coming back to the governance again, are probably the most important factors to ensure that there will be enough funding all along until exit, hopefully.
Yes. There's another question in the back.
Apologies. Okay, so I'm slightly biased. So my name's Johannes Gunnell. I work at Maris. So we actually started off as a venture capital fund. We converted into a permanent capital vehicle in 2014, having performed pretty well. And so we felt we should do it from a position of, kind of doing it from a good point of view. And most of our, all of our limited partners agreed to it. Our view on it was that if you're investing in Africa, it's long time periods. A lot of the businesses we'd actually started ourselves. And actually, even now, if you look at our portfolio, we're investing in forestry and growing trees, which won't mature for 20, 25 years. For us, the important thing is, making sure that the businesses perform well and, being able to take a long-term view. And for that was the reason we did a permanent capital vehicle. So then the question is, particularly, I guess, for DFIs, is, if we're kind of doing what you want in terms of impact, generating returns and so on, if you do have a permanent capital vehicle, you guys obviously worry about liquidity, but then actually probably happy to put more money back into Africa anyway, but you kind of need to feel there's liquidity. If I put you on the spot, what would be an acceptable dividend yield from a permanent capital vehicle for you to stay in it for 20 to 50 years?
I suppose the question's to me.
Be careful, it's recorded, huh?
So the return, the yield we would want would be what would be an acceptable return for the risk, and so no, I think the so we have our, I mean we have traditionally always had a mandate to recycle capital, right? That's something that we wanted to do, but I think we've done it a few times where we've sold and reinvested. At the same time, over the last couple of years, discussions with management, we've been encouraged to look for yielding assets, and I think there are investments where we've been in for 25 years and receiving a very interesting yield. I mean, what would that yield be? I mean, it depends on the sector. It depends on a number of things, right? So it's hard to. I wouldn't want to put a number out there, but. At the same time, I mean, you mentioned forestry, and I think it's a very interesting sector where we need to look at permanent capital vehicles, because effectively in that sector we're not only getting financial return but also carbon credits, hopefully, and so in that instance we're not a seller and we don't want to be a seller. So I think you're going in the right direction. So hopefully we can discuss a bit offline.
All right. I think our time is up, so I'd like to ask you to thank our panelists for their contribution.
Thank you.